Welcome to Market Call. I'm Morella Fernandez. Rebecca Teltscher is on the show today, portfolio manager, Newhaven Asset Management. She's going to take your questions on Canadian dividend stocks. Here's how to reach us if you have a question. 1-855-326-6266. That's the toll-free number. You can email your questions into marketcall@bnnbloomberg.ca. Rebecca, thanks for coming in. Appreciate you joining us on the program today. What do you make of that rally, comeback rally, Monday and a part of Tuesday ahead of the weekend announcement by the American administration?
Yeah, so I mean, it's not even just the rally that we saw this week. Obviously, it continued, but we've really seen a huge rally from, the bottom that we experienced since, Liberation Day in early April. So we've seen like almost a 20% rally in the S&P 500 from the bottom. We're now looking for the U.S., like on the S&P 500, year to date, we're now in positive territory. TSX, we're up 3% year to date. And I mean, I'm kind of scratching my head. Like, I get the fact that the worst case scenario is no longer priced into the market with this 90-day pause on tariffs, but I'm looking at the economy. The data coming out on the economy is not looking great. It's mixed at best. And then I'm looking at other things like geopolitical risks are just keep increasing. And then, whatever rally we're seeing with regards to tariffs, like that's not completely gone. I mean, yes, maybe worst case scenario is no longer the case, but this is a 90-day pause. This isn't a permanent solution, and there's still a lot more to unfold here. Okay, so what kind of data are you looking at that gives you a reason to pause? We had housing numbers come out today, but I just want to get a better idea of what you're looking at to make you feel that, people are being a little bit optimistic here. Yeah, so I mean, so let's break it down to Canada and the U.S. So in Canada, I mean, we're seeing consumer confidence is, coming down, okay? We're seeing housing, housing is lower. I think housing starts are in the lowest place that they've been since 2009. We're seeing job numbers that are not great, loss of jobs, unemployment is starting to tick up. And that's even without the impact of tariffs coming in. We have a consumer that's highly indebted, that, mortgage rates are going to be coming up, like the prices of mortgages are going to be coming up as their old mortgages roll over from COVID. In the U.S., I mean, we've really seen consumer confidence plummet. Like that was a real shock. Like since, Trump got elected, really, like since the beginning of the year, we've seen consumer confidence come down. Retail spending was is coming. It was okay, but if you think about the number that was released earlier today, I mean, it's up 0.1%, but that's with a lot of the pre-tariff buying pulled forward. So if you looked at what was impacting it was we saw motor vehicle purchases and parts were a large positive. If that wasn't there, if there wasn't that pre-tariff surge in buying, I think retail spending would be down. And then you have ISM manufacturing that's in contraction territory, that continues to be in contraction territory. So I look at the economy right now, and it's murky at best. Okay, I feel like you think that the next set of data will be a lot worse. I think, if it holds on, it won't be for that much longer. We're already seeing softening in GDP numbers. We saw that both in Canada and the U.S. a few weeks ago with GDP numbers softening. I wouldn't be surprised if Canada's already in a recession or the start of a recession, but we're just waiting for those data prints to come out, since it's a backward-looking data set. And in the U.S., I think, employment's still strong, so I think that's what we're looking at. But if I think about who's been hiring the most for employment numbers, it's government. If you look at what's going on with DOGE in the United States, I don't know if government jobs are going to come to the rescue this time in the United States, as we see that those numbers are coming down. So there's not that much to be excited about with regards to the overall market. There are certain areas we're excited about, particular areas of the market that are more conservative, more stable. That's what we're focusing on. But in terms of the overall market and the optimism we're seeing, we're a little bit skeptical. Got it. Okay, we're going to line up some phone calls for Rebecca Teltscher. She's portfolio manager, Newhaven Asset Management. She's taking a question today on Canadian dividend stocks. We'll line those up as we go to break. We're back in a moment.
Welcome back. Thanks for joining us here on Market Call. Let's go to an email from Tony. Tony says, now that BCE has cut its dividend, would you consider it a buy? BCE, of course, cut its dividend by 56% under a lot of pressure to do it. Parent company of this channel under the Bell Media brand. A lot of people have been looking at this stock and saying, now what? What do I do with it?
We're saying the same thing.
Yeah.
Okay, now what? I mean, the reality is, and it's very unfortunate that a company, such a strong Canadian company with a solid track record of dividend increases and such stability over so many years, and it's just a shame that this is what it's come down to. Did they need to cut the dividend? If they hadn't bought Ziply, I don't think they would have had to. I think there was a lot of pressure from institutional investors to cut that dividend. Anyways, it's done now. It's yielding 5.8%, so it's still a decent yield. Obviously, there's not going to be any dividend growth. If I look at telcos in general, there's a lot of, we're looking at slower immigration growth. We're looking at competitive pressures. That should get better, but maybe not immediately. And regulatory pressures from the CRTC, now that the same government got voted in again, I don't know if that's going to ease or not ease with regards to regulatory pressure, but I don't necessarily think the telcos are going to be growing so much this year. That being said, BCE in particular, now that there's more transparency with regards to their payout ratio, the dividend cut, they've also partnered with PSP for the Ziply acquisition for future growth. So with a lot of the financial pressures taken off of them, I do think that there could be an opportunity for a valuation gap. So we could see the stock tick a little bit higher as maybe valuation comes up a little bit more since there's more transparency with regards to the future. I do think over a very long term, I think the telcos will be okay because they supply critical infrastructure. If we are going into a weakening environment, I think the telcos are a nice place to be with regards to the stability and defensive nature of their operations. But I wouldn't be buying BCE today for a short 6 to 12 month pop in the stock price. This would be a solid long-term buy and hold.
Got it. Okay, let's go to the phone lines. Gordon's on the line today from Victoria. Hi, Gordon.
Good morning. ATCO, dividend aristocrat, overlooked because there's a controlling shareholder. A big part of the company is their controlling interest in Canadian utilities. And if you strip that out of the ATCO share, compare it to other regulated utilities, I think you're getting it at quite a discount through ATCO. And then you have the ATCO businesses, the International Modular Structures business, where they're a leader, should be excellent growth looking forward. And the part of the business nobody talks about, which is the acoustics business. And I think noise abatement is going to be a business that's going to grow well above the rate of GDP growth moving forward. What do you think?
Yeah, so good question. ATCO, and as you mentioned, Canadian Utilities, they've predominantly always traded, or at least in the past few years, traded at a discount compared to some of the other larger utilities like Emera and Fortis. We don't own it. Utilities is our largest sector weighting. It's one of the ones that we don't own. We prefer Fortis and Emera just because we like the geographic diversification of the utilities. So utilities are rate regulated, so they earn a set fee based on the regulatory jurisdiction that they operate in. For Canadian Utilities, it's predominantly in Alberta. Alberta is not a bad jurisdiction by any stretch of the imagination. Like, I would prefer Alberta and CU over Ontario and Hydro One. But we prefer to have a little bit more diversification. So, we prefer Emera and Fortis. They have more U.S. utilities that have been just growing a little bit faster. Emera has utilities in Florida, which has been the fastest growing geographic location in the United States. And Fortis has transmission lines that are in desperate need of modernization. So I don't think there's anything wrong with Canadian Utilities or ATCO. ATCO, again, it's trading at a discount. I have no problem with their logistics business or the acoustic business. I think over a long term, it's great. You're getting a good, solid dividend yield. They have a good dividend policy in place. But again, you're going to be paying that discount just because they're not as diversified geographically as some of the others.
So they're a good company. There are others that might be a little bit better.
For us, but if you own it, I wouldn't see a problem continuing to own it, especially in a market like this.
Got it. Okay, let's go back to the phone lines. David has a question. He's in Ottawa today. Hi, David.
Yes, good afternoon. Thank you for taking my call. My question is on Enbridge. Last Friday, I believe, they came out with really great earnings. And I don't understand why on Monday the stock fell by more than $2, and now it's around $62 and change.
Yeah, I mean, it's a good question. I mean, we own Enbridge for a very long term. Like, I come from my previous firm that I worked at prior to Newhaven, like they've owned Enbridge since its initial IPO in 1953. So, wow. I mean, we're talking really long term. So in terms of what it did on a day-to-day basis, I mean, I'm not sure exactly what's happening there. But if I'm looking at the valuation, it's reasonably priced. They're getting almost 6% dividend yield. They're doing exactly what they're saying they're going to do. They have a lot of CapEx projects, and instead of some of the other pipeline companies that are maybe focusing on one large, CapEx program. So there's like project risk. With Enbridge, it's a little bit more diversified, some small projects here and there that are going to create incremental growth in the future. You're getting dividend growth at almost 6% yield. I mean, to me, we're going to continue to own it. They made an announcement today that they're selling a portion of one of their pipelines. That money is going to be redeployed back into the business. So they don't need to be issuing any equity to be funding some of that growth. So,
what did you think of that decision to sell? I think it's 12.5% to an indigenous stake in one of their gas pipelines.
Yeah, and I think that was a good business decision. I mean, they're basically taking an existing asset and they're redeploying that cash into some projects that are going to have future growth. So to me, I think that's a great way to. It's very known that Enbridge and TC Energy, like they're going to be having to monetize some of their assets to be able to fund some of their future growth projects. And I think I think this was a good call for them.
Yeah, got it. Okay, we are going to take another quick break. Line up some more phone calls and emails for Rebecca Teltscher. She's portfolio manager, Newhaven Asset Management. We're back in a moment. Welcome back. Thanks for joining us. Let's get back to your phone calls. Matt's been holding on the line. He's calling from Winnipeg today with his question. Hi, Matt.
Hey, thanks for taking my call. Calling about Whitecap Resources with the recent merger with Varen, and I guess being one of the largest landholders in the BC Alberta area in the Duvernay area. I'm just seeing what your guest thinks in the next 12 months where the stock's going to go to. Thanks. Thanks
for the question. So the Varen Whitecap merger.
Yeah, so not a name that we own. I'll talk a little bit about the energy producer that we do own in my top picks. The truth is, I do see that there could be a risk for oil prices coming down in the next 6 to 12 months. Like, I wouldn't be surprised. So at the moment, we are dealing with a weakening commodity price. I think it's important to own a stock that can that could withstand commodity price volatility. So that has a good, strong balance sheet, not too much debt, and strong assets. So, I mean, I don't have anything against Whitecap and Varen. I mean, their assets are generally, lighter oil, so they are subject to higher decline rates. So I think their decline rate's about 26%, so lower than, let's just say, some of their peers, but, higher than what I would feel comfortable with owning. I do think that they're going to see a lot of synergies, so you can kind of extract some of that from that should do better for earnings in the short term. But in a weakening commodity price, I mean, I'd be a little bit hesitant to own this one in the short term, as they're digesting a lot of debt. Trying to extract some value there, but and some higher decline assets.
Got it. Okay, let's go back to the phone lines. And John's on the line from London, Ontario. Hi, John. What's your question?
Hi, Marilla. Hello, Rebecca.
Hi.
Rebecca, thanks for covering telcos and energy pipelines and utilities, three classic dividend pairs. Of the other dividend pairs, sectors, do you prefer transportation, including railways, REITs, or financials? And you don't have to give me an example because I'll look for your top picks. Thanks very much.
Thanks for joining us, John. A lot of choice there.
Yeah. So, I mean, that's a great question. I like that one. So, So transportation, rails. Definitely something I'm looking at now. It's CNR in particular. I mean, it's the higher yield, lower valuation. is looking interesting. I mean, it's come up quite significantly just with this market run in the past. You could see right there in the past like week or two, it's over 150. I mean, to me, like I was looking when it hit like 136, 137, like this is getting really interesting. I'm so close to wanting to dabble in it, not at 150, but if it goes back down around like 125, I think for sure we'd be interested in it. Again, it fits the bill of what we're looking at. Stable companies that are not easily replicable, that pay consistent cash flow, and that has a dividend that's backed by that consistent and growing cash flow. I think the rails, again, it's still the cheapest way to transport goods. So if we are going to get into transport, it would be through the rails. I do like CNR better than CP with regards to valuation and dividend yield.
Because of their reach as well across the border, or?
Exactly. And I just think that the valuation is higher on CP because there's a lot of embedded synergies there. If they don't reach their synergies, like I'm very nervous in this market with any stock that it has too high of a valuation. I think to me, I want to stick on the more conservative side. That would be CNR for me. So that would be a sector I'm looking at. We don't own it right now. I can't remember the other two.
Financials and REITs, I think.
REITs and financials. Okay, so REITs we don't own right now. Again, you can't. REIT is a big bucket. So if I look at REITs, there's retail REITs. Again, consumer discretionary retail spending. I'm not so confident on that space. Residential, I think, would be interesting. Rental space, as immigration comes in, there's not enough housing. But when I looked into some of the particular ones, like Cap REIT, I wasn't so interested because they're selling some of their old assets. Very few new assets to be able to buy, so I wasn't as interested. And then industrials, I think that already had their big day, with regards to in the pandemic, easy to replicate, cheap space. I think prices are going to come down there. So haven't found a REIT that I'm interested in yet. We are looking. And then with financials, I mean, we do own financials. It's kind of hard not to own some of the banks in Canada, but we are underweight. I think there's going to be some increase to provisions that we're going to see this quarter because they did not take it last quarter. I want to see how they're going to do. I think they are set up well for a recession in Canada, but there may be some weakness this particular quarter that I'll be keeping my eye on.
And that happens next week. A lot of the banks reporting then. Okay, let's go back to the phone lines. Peter's on the line from Victoria with a question. Hi, Peter.
Good morning, good afternoon. Thanks for taking my call. My question is on Algonquin Power. Thank you very much.
Okay, thanks, Peter. That was quick and easy. Algonquin Power.
Yeah, so it's a name we own. It was one of our worst producers in 2023 and again in 2024. So if you recall, I mean, they were kind of split between their renewables business and their pure play utility business. They then sold off the majority of their renewable business. They've been working to transition to a pure play utility similar to a Fortis and Emera, and they're doing everything they can. I mean, basically, I would say if you're looking at Algonquin today, you're looking at it as a reset. So they have a new CEO and like a new management team in place. They're now basically a pure play. Like they do still have some renewable hydro assets that they're holding on to. Small, I think it's just 3% of their overall, so very small. But you're now looking at a pure play asset. Most of their utilities are in the U.S. So again, talking about geographic diversification, they have lots of small utilities across the U.S. What's nice about that is that when they are applying for a rate reset, so as interest rates come up, they're going to apply for rate reset. Any money that they deployed into the utility business, they can then try to recoup those costs through a higher equity thickness or a higher ROE return that they earn. So when you have several jurisdictions, you have different rate cases that are still pending. They may all get approved at different times because some of them are annual, some of them are every 2 years. So the good news about Algonquin is as they're transitioning to this pure play utility, they may see some upside in their rate that they're earning as these rate cases get filed and approved. So we like the business. We think at this point it's the cheapest way to own pure play utility assets, so you're getting them at a discount because you're taking a chance on the new management team going forward, performing and doing what they say they're going to do. I think that they're doing a good job so far, but it's really just the beginning of this transition into a pure play utility.
Got it. Okay, we are sticking around here with Rebecca for her past pick that's coming up right after the break. Stay tuned. Welcome back. We are going to have a look at past picks from February 5th of 2024 for over a year ago. At the time, Rebecca had picked CAE, which was at 26.45, today at 35.54, so 34% upside return for total return, 34% as well. I was just taking a look at the 3-day look because they reported earnings this week. They're down over 3 days, sort of 4.3%. Their earnings were good, but was it their guidance that people were concerned about here?
Absolutely, yeah. It was exactly that. It was their guidance. And so, again, we try to take a really long-term view on these stocks. So, I mean, we could talk about what happened in the short term, but really what we're looking at, and what's interesting about CAE is it's one of the few stocks that we own that actually don't have a dividend. They had a dividend in the pandemic. They cut it, but that's when we actually bought it because it checks all the other boxes in terms of long-term recurring revenues, very stable business. So the larger segment is the civilian, so civil airlines. They do the flight simulations and training for pilots. It's very clear that there's still an ongoing pilot shortage in North America. As pilots get hired, they're going to be needing to be trained on the flight simulators. Obviously, a pilot that gets hired on day one is not going to be flying the biggest airplanes. They have to start small, and they have to do continuous flight simulation learning as they try to upgrade on bigger aircraft models. They also have smaller division on the defense side, where they do, aircraft simulation for some of the defense. So Royal Canadian Air Force, as an example, they just signed a very long, I think a 25-year contract earlier this year or maybe last year with them. So the stock was off last year because they had inherited, when they bought the defense division, some poor contracts that had really small earnings. Management said over time that they were going to be increasing those earnings as some of those legacy contracts come off. And they did exactly what they said they're going to do. So margins in the defense side were keep going up and up and up. And the stock really took off. You saw from like $25 to $35. 2 days ago, the stock came off about 6% because guidance is lower for next year. Again, on a long-term basis, that secular trend of pilot shortages. Right now, when I look at geopolitical risk, I'm thinking having some exposure to the defense side through flight simulators, not a bad idea. So we think it's a great opportunity. If some of our clients didn't get in at $25, I bought some more for them a few days ago when the stock was down 6%. I think it was just a short-term blip on some short-term trading, but on a long-term basis, I think it's still solid.
Just out of curiosity, how much civil, how much defense? If you know off the top, sort of
small. I can't. Less than 20% would be defense.
Got it. All right. Let's get to your next past pick, which was Emera, and at the time you recommended it. So this was February 2024. We will pull up that board. It was 47.67, and it's jumped to 60.25 in that period. So 26% upside return, a 34% upside return, and they do electric and natural gas generation. You had mentioned this, touched on this earlier, but expand on why you like Emera.
Yeah, so that distribution utility, I mean, it has done a fantastic job. So again, their largest distribution utility is in Florida through TECO Energy. And again, Florida population growth has been soaring since the pandemic. So, and it's a great regulator. For example, when they had those hurricanes in the Tampa area a few years ago, they were able to recoup all their costs. So the regulator is good. They're pretty quick in terms of recouping costs and letting the utility earn a solid rate base that continues to grow. They have they're diversified, so they have utilities in New Mexico that's actually up for sale, but Florida, but Nova Scotia Power as well. They've done a really good job in terms of they've beat for 3 quarters in a row. When I recommended them, they were trading at 11 times PE, so it was just a no-brainer to me. I mean, they had, I think, a 7% dividend yield at the time that was continuing to grow 1% to 2% a year. And in general, what we've seen this year is as there was that risk-off sentiment with regards to tariff uncertainty, we saw a lot of money come out of these riskier technology sectors and into safe, more defensive sectors like utilities. And that's why, Algonquin, Fortis, Emera, they're all up. So, this is exactly why we like those businesses. Stable utilities, stable earnings, consistent cash flow, consistent dividend yield that's growing over time. I mean, this is what we're looking for.
Got it. Okay, let's get quickly to your last past pick, which was Brookfield Infrastructure Partners, recommended at 42.03 in February of last year, 44.70 now, so an upside of 6%, total return of 13%. This is sort of one of those quality companies that you like long term. You're not going to see spectacular growth, but it'll be steady.
I'm surprised it hasn't done better than what it was stating there. I mean, this one is the one that I keep scratching my head at why it's not, why it just kind of keeps it's just range bound, under $50. But regardless, I mean, we're happy to continue owning it. So Brookfield Infrastructure is a utility, but unlike other utilities, they're more diversified, one geographically. So they own assets across the globe, South America, Europe, India. They own, assets across the globe. And then they also have a more diversification in the types of assets they're looking to buy. So they'll own airports and toll roads and data centers. So, I mean, they're utility because the majority of their assets are in utility, but they also have a more diversification in terms of the asset base, which we like. Again, all long-term either rate regulated or fee for service. So their revenues are pretty contracted. What we like about them is they have a strong management team. They're what we call capital recyclers. So they buy assets that they deem undervalued. They'll own it, they'll fix it up, and then they'll end up selling it at a high valuation. I think the stock is off because maybe as the economy weakens, there's questions, will management still be able to sell assets at a premium? The answer is so far, yes, they're still doing a really good job. For us, this is like that yield plus growth. So you're getting almost 6% dividend yield that's growing. It's growing faster than some of the other distribution utilities. But you're also getting growth through that capital recycling program. So this is also a long-term hold for us.
Got it. Okay, let's line up some more phone calls, some emails for Rebecca Teltscher. She's portfolio manager, and she is with Newhaven Asset Management. She's going to stay tuned to take your questions on Canadian dividend stocks when we come back. Just want to share that the TSX has risen 0.7%, actually a little bit above that right now, hitting a record high of 25,875 or 76, where it was a short time ago. So that is its highest ever closing or value was 25,808. That was the closing value on January 30th of this year. So again, the TSX up today, shooting up 182 points, up 0.71% at this point to a record number, beating what it was at the end of January. So just bringing you that news now. Let's go back to the phone lines. Kevin is on the line. He's calling us from Kingston in Ontario with his question. Kevin, what is your question today?
Hi, thank you for taking my call. I've been watching the TD Bank very closely over the last 4 or 5 months, and it's been inching up almost every single day, except for that downfall we had in April. And I'm just wondering, it's at 90 and change right now. It still pays a pretty hefty dividend of, I think, 4.70 or something like that. And I'm wondering if you would be stepping in to be buying at these levels. I know it's having its earnings next week. And just curious if you would continue to buy at this price level. Thank you.
Okay, thanks for the question.
Yeah, good question. I mean, a few months ago when TD was at $78, I mean, it was a screaming buy to me, even though it had some risk with the AML issues with the U.S. Money laundering, and then they were capping their growth in the U.S. Because I actually like their Canadian business. I think their Canadian banking business is one of the premium banks, that and Royal. So on the Canadian side, I like that. Back when it was $78, I mean, the valuation was so cheap that you were basically not even paying for any of their U.S. operations. So to me, I was just happy to own, let's just say, the Canadian side. You saw them do a transaction, like they sold their stake in Charles Schwab. They're going to redeploy that asset back into Canada. At $90, I would be hesitant to go into any bank right now until they start reporting earnings. I think the consensus is that they're going to be increasing their provisions for credit losses. They didn't take any too much provisions in Q1. Again, as I said, if Canada is going through a recession or getting close to a recession, those provisions should probably come up. I think the market at this point will be paying for the bank that's the most conservative, so taking more provisions. Let's look at what TD does. I do think, if you look on a valuation basis, so there's a huge discrepancy between Royal's PE multiple at about 13.5 times to TD's at 11 times. So I think there is room for TD to go up from here. Let's wait for more clarity on what's going on with regards to the U.S. anti-money laundering. What's their plan with regards to growing in Canada, since they are capped at growing in the U.S. So I do like TD. I'm not sure I'd be buying it at $90. I'd kind of want to wait and see from here. But I think on a very long-term basis, TD and Royal are the two premium banks. So I'm okay paying a bit of a premium to own those two.
Got it. Okay. So, and again, a reminder that earnings are next week, so it's something to watch out for that. Let's go to an email. Art says, hi, I would like to get Rebecca's opinion on Telus and if the dividend is safe. So we've talked a little bit about telecommunications. We talked specifically about BCE. Do you see Telus sort of in a different position here?
Telus is absolutely in a different position than BCE, and I can understand. You look at BCE; they just cut their dividend. Their payout ratio was above 100%. Telus's payout ratio is also above 100% right now, not to the same extent that BCE was. And again, had BCE not bought Ziply, I don't know if they would have cut their dividend. So I do not think Telus's dividend is at risk. In fact, they've announced that they're going to continue to raise their dividend this year. Actually, investors didn't like that so much. We, as dividend investors, do like to hear that consistency in the shareholder return, but not at all the same as BCE, so I think their dividend is safe. Their CapEx for sure is going to be coming down. So compared to the other telcos, they are way ahead of the others with regards to their large CapEx spend, so the fiber to the home. They are well over the hump. So CapEx is going to be coming off in 2026, 2027. As that CapEx come off, cash flows are going to continue to go up, and that payout ratio is going to come down. I think they are, they are trading at a premium, but they are the premium telco right now because they are in a better financial position. And again, some of the regulatory overhang, the population growth, and the pricing environment being competitive is still going to probably keep the stock, range bound for now. But I do think on a longer term, there could be some growth in Telus. I mean, it is trading on a 5-year basis, on the lower end of the range. So I do think once the macro environment improves, we should see a pickup in Telus.
Got it. Okay, we are going to take a quick break, line up some more phone calls. We're back in a moment. Stay tuned. Welcome back. Thanks for joining us. Nicole has been holding on the line from Montreal with her question. Hi, Nicole.
Hi, ladies. I always get excited when I see two ladies on the show.
Agreed. So do we.
I wish it would happen more often. Anyways, my question is on Constellation Software. Why is it not splitting? And, is there a reason why? Anyways, thanks.
Okay, thank you for the question. Let's have a look at Constellation here.
Yeah, good question. I don't know why it's not splitting either. I don't have a good answer for you. I could talk about Constellation Software and just in general. We don't own it. Valuation is pretty high. Strong management team. They have a decentralized model where they basically acquire vertical businesses of different software companies, and they've done a really good job. But we try to stay away from companies that are basically just focused on M&A growth for two reasons. I mean, one, M&A works until it doesn't, right? It works when you have a certain valuation, but then, but then also as you get bigger and bigger, and as you see with Constellation Software, the company keeps getting bigger and bigger and bigger. So to move the needle in terms of its overall growth, your acquisitions have to start getting bigger. So you can't do these small tuck-in acquisitions. You have to start buying larger acquisitions. And as you get larger, there's a lot more competitors out there, particularly in the US, that are looking to buy these software companies as well. So more competition, you're paying a higher price, and we kind of wonder if that multiple will come down over time. So not a name that we own, despite them having a good track record and a good management team.
Got it. Okay, let's move to Gulam, who's calling from Toronto with her question. Hi, Gulam.
Hi, good afternoon. My question is on Freehold Royalties. I'm debating between buying that one and Nova Scotia. Freehold Royalties for the dividend, which is close to 8%. Bank of Nova Scotia, which I hold, but I need to dollar cost average that down. So there's also capital appreciation, but a lower dividend.
Yep.
Which one to go for?
So based on today, like I said, I probably would hold off on owning any of the banks until I see how their earnings, how they report next week. Again, I'm expecting some higher provision for credit losses. I would own Freehold today. Again, we're in an environment where oil prices are down, so that's why the stock prices come off. In the meantime, Freehold pays a 9% dividend. That's, their dividend is pretty safe at these commodities, even though oil prices are down, even at these commodity prices, the dividend is pretty safe. And so they're a royalty company. So what's interesting about them is that they don't have to deploy that much CapEx compared to, let's just say, smaller E&P, some of the smaller energy miners. They're not deploying that much CapEx. They just own the royalties. Obviously, there is some commodity price embedded into their earnings, but they're not deploying that capital as an initial outlay. They are going to be doing some acquisitions, particularly in the U.S. The environment is a little bit competitive, so we're expecting slower acquisition growth in the U.S., but I'm happy owning it at a 9% dividend yield while we wait for the stock price to recover as commodity prices continue to rise, and we're just happy owning it for the yield for now.
Got it. Okay, let's go back to the phone lines. Mara's on the line from Toronto with a question. Hi, Mara.
Good morning, ladies. I just have a plain ordinary question on Capital Power. I've been watching it recently and seeing that it has been moving in a good direction, and would just like your thoughts. Thank you.
Okay, let's pull up Capital Power there. It's up 2.5% just today, $1.36 up, 46% up, and 20% up over 3 years' time.
Yeah, so it's been a little volatile, and I'll explain to you why. So Capital Power, it's a utility, but it's not a regulated distribution utility. They're a power generator. They used to own, lots of coal in Alberta. They've now diversified, so they've converted it to natural gas, so they no longer have coal in their fleet. Predominantly natural gas. They still have a lot of their assets in Alberta. They've been doing some acquisitions in the U.S. as well to diversify. So that run up that we've seen last year, that you see in 2024, was all because of Alberta. There was rumors, or there is plans to build some data centers there.
Okay.
And the stock, so TransAlta and Capital Power being the two largest power generators owning a fleet in Alberta, it really ran up, and we feel way too much, because while there are plans to build data centers, there was nothing concrete. I don't think there was anything that actually FID, there was no final investment decision for any of these data centers, and we haven't really heard that much talk about it in the past few months. So I think it was normal that the stock has come off since then, because it really ran up too much. So you would be, and it's still pretty high relative to where it was in earlier 2024. So in our opinion, we rather own, if you're going to own a power generator, we rather own one that has more consistent growth. So the two that we own is Northland Power. They have 3 power projects that are actually in construction right now. They are in the middle of their construction phase. It's on time, on budget. They should come online. Those projects should come online in 2027. So there's more concrete growth there. The other one we own is Brookfield Renewables. They own a lot of hydropower, which again, long life assets, and they also have a partnership with Cameco for Westinghouse, which is nuclear, and we're pretty bullish on nuclear power generation right now. So Capital Power, I think nothing wrong with the generation of the fleet that they own. I think there's something wrong with the valuation coming up so high. Until we get more clarity on some of those data centers in Alberta, I would be a little bit more cautious on that one.
Got it. Okay, we do have to take a quick break. When we come back, Rebecca shares her new top picks. We're back in a moment. Welcome back to Market Call. We are going to look at some new picks from Rebecca. Her first one lined up is Canadian Natural Resources, which is a very well-known stock. What do you like about it moving forward?
Yeah, so it's not so much of a new pick because I think this was my top pick like 2 times ago, and I'm just going to keep picking this one forever at these prices. I mean, this is a no-brainer to me. It is the premium Canadian oil stock, and it's a very rare opportunity that you get to own this premium asset at a discount. Again, we're talking about oil prices coming down. Commodity prices may get weaker as supply comes online internationally. So there could be some weakness in the commodity price. That being said, this is a great entry point. You're getting a 5.5% dividend yield. They keep increasing their dividend multiple times a year because they have such a strong a culture of maximizing shareholder value through buybacks and dividend increases. And with regards to their asset base, I mean, they are best-in-class premium assets, low decline rate. So their overall decline rate is about 11%. When we were talking about, Whitecap, it's 27%, which is, still low. But we're really talking low decline rate, a good mix between oil and gas, and you're really talking about premium assets and low break even. So they're one of the few producers that are still going to be making money even in a low commodity price environment.
Got it. Okay, let's get to your next pick then, which is Cro Linen, which had announced a deal this week as well. They made a purchase in Asia, I believe. Did you like the deal they did?
No, it was actually in the UK.
Sorry, thank you.
Yeah, that's okay. So it's interesting. I sent my top picks 2 days ago, and I was like, trying to get ahead of it. And in the meantime, yesterday they announced this acquisition, and so it wasn't even in my notes. But they do laundry. So if you think about it, very boring business.
Hotel, hospital, laundry.
About 50-50 in terms of hotel and so hospitality and healthcare. So hospitals, sterilization for operating room equipment and things like that. They were predominantly in Canada. They started doing small acquisitions in the UK. So I think they started in 2017. Then they dabbled in it, got to know the market a little bit better, made another one in 2024. And then they announced yesterday this big transformational acquisition in the UK. So before they were just operating in small areas like Scotland and Northern England. I mean, now they're really across the board in the UK. Their business now, like they used to have, less than 5% market share in the UK. Now they're a big regional player. Their breakdown between UK and Canada is now 50-50, where it used to be, let's just say, a smaller percentage, I think 25% UK. So transformational growth. They issued equity, so that's why the stock was down 5 or 6% yesterday. We think we've met with the management team several times. Strong management team. We like their slow and steady growth. This is a big transformational growth, but they know the market. They are now a regional player. It's still a very fragmented industry, both in Canada and in the UK, so we could expect more. I mean, once they're done digesting this, we can expect in the future more small tuck-in acquisitions. In the meantime, they're going to do this is automatically accretive to their cash flow, and there's going to be a lot of synergies now that they have a lot more facilities in the UK. So again, boring business, very stable in terms of long-term contract. If you think about the healthcare side of things, I mean, whether the economy is up or down, people need their laundry done, hospitals need their laundry done, and it needs to be done quick and efficiently, and they're one of the only operators that does it, one of the only public companies that does it.
I was considering or asking you about the hotel side of it, because that side, there's a bit of room to sort of not have the income if discretionary spending goes down, people aren't traveling, we don't know.
Absolutely. So there is some cyclicality there. That being said, I don't think they're going to stop laundering. But on the positive side, if let's just say some of the hotels do suffer financially, one of the things that they can do is if let's just say they were doing their in-house laundry themselves, they can now free up some capital and sell their laundry business to, or outsource their laundry business to Cro, because it's really capital intensive to have the laundry facilities on site for some of these big hotels. And so if you outsource it, then it could be a positive for KBL. But yes, there is that cyclicality in the hospitality business, but we would think that could also be a positive for new business.
Got it. Okay, let's get to your last topic, which is Pemba Pipelines, also very familiar name to most investors. Tell me what you like about Pemba moving forward. They're at 52.33 today.
Yep. So, I mean, we like Pemba. I mean, they're integrated from the entire value chain across almost all energy commodities. So if you think about it from the wellhead to the end user, so let's just take a gas molecule comes out of the wellhead, they're going to be earning revenue from the gathering pipe, from the storage facilities, from the gas processing, and then from the end, then the transmission line, and then from the end user, whether that's going to be their marketing division or their export division, whether it's going to be LPG, so propane exports, LNG. They're working on a really big, well, big for them, LNG export facility off the coast of BC. So they're earning revenue through every step of the way along the gas and oil molecule. So we like their strategic positioning. We like their growth. We also like the dividend income, about 5.5% dividend yield. They just raised their dividend 3%. They continue to raise their dividend, and their dividend is backed on the fee-based business of their earnings. So 80 to 90% of their earnings are contracted, whether it's through take-or-pay contracts, so they're getting paid whether there's oil on the pipe or not, or fee for service. So very little commodity price exposure, and their dividend is based on that. So very safe dividend, very safe and consistent earnings, and very good operators. They've done many acquisitions over their entire lifespan, and we just think that at this price, at $52 and a 5.5% dividend yield, it's a long-term buy and own.
Got it. All right, I got to leave it at that. Rebecca, thanks for coming in. Appreciate your time on this. We do want to get to the new high for the TSX today, an intraday high. The last high was January 30th. It beat that today at 25,881. Thanks for joining us on Market Call. We'll see you again tomorrow.